So, hello, Finamizers. Welcome to another Finamize Live. My name's Russell. I'm an analyst here at Finamize, and I'm happy to host today's event on the Insider's Guide to Leveraged and Inverse ETF Trading with our partner Direxion. First, we've got some housekeeping to run through. As you're coming in, please fill out the poll. Feel free to introduce yourself in the chat, tell us where you're tuning in from, and remember to switch to all attendees so everyone can see your messages. The plan is to have a 15-minute discussion followed by a 15-minute audience Q&A. Please use the Q&A box to ask a question, and if you see a question you like, vote it so it moves to the top. That way we can get through the most upvoted questions first. Okay, so our event partner today is Direxion, who specializes in providing decisive investors with solutions that deliver flexibility to position portfolios opportunistically. Direxion builds products for investors who want more than the status quo. Their index-based products deliver directional options, magnified exposure, and long-term rules-based strategies. And we're excited to welcome Egilinsky, Managing Director, Head of Sales and Distribution, and Head of Alternative Investments at Direxion. Welcome, Ed.
How are you?
Great to have you here. And how are you doing today?
Nice to be here, Russell. Cool. So let me start off, Russell, with a little of the, when we look at disclosures, and this is just a necessary evil, I just want to mention that please read the prospectus as well as any pertinent marketing materials before considering trading any of our leveraged and inverse ETFs. We'll talk about this a little later. Education is very important, first and foremost, just like it is for your viewership. It is very important for Direxion initiatives. So we also have on our website an educational section dedicated to leverage and inverse ETFs. But with the disclosures aside, let's get to it, Russell.
Sure. So let's start with the basics. What exactly are leveraged and inverse ETFs, and who's best suited to use them?
Yeah, it's a good question. Leverage and inverse ETFs are designed to provide magnified exposure to an underlying index or a single stock. Most of our products are 3 or 2 times leverage, and they're really meant for sophisticated active traders who want to express a short-term magnified view. These are high-risk reward instruments. They're not for investors, but for active traders. And these really need to be monitored daily. They're not buy and hold vehicles. And I'll touch on more of this later. But our ETFs have a daily reset of leverage. And these will track for any given single day. But once you own beyond one day, there will be something called compounding. And that leverage can work for or against you. And we obtain leverage through what's called a swap, where major banks provide us that daily exposure. And, you know, the advantages of a leverage and inverse ETF is that you can express leverage without the need for margin because these are packaged as an ETF. And for those of your viewers who maybe feel that they want to short the market or an inverse fund, which can take advantage if markets decline, here's a way for those investors to express an inverse view with their liability limited to to their initial investment because it's packaged as an ETF.
That's great. Thanks for that. That's a good starter. So then, I suppose the next question, a new type of leveraged ETFs come to the market somewhat recently, single stock ETFs. Would you kind of explain what those are and how they're different from other leveraged ETFs?
Sure. As the name denotes, they provide leverage on an underlying common stock. And in our case, we have single stock exposure to the Magnificent Seven. That includes the likes of the NVIDIA, Tesla, Apple, etc. And these are 2x bull products. If you want to express a short-term view, you think those individual stocks will go up. Or if you want to take a non-leveraged inverse bearish view, we have those tools for you as well. And one of the things you got to be aware of with the leverage and inverse single stock ETFs is there is a greater concentration risk than a broader index itself because, of course, it just consists of a single stock. So our leverage and inverse single stock lineup consists of, as I mentioned, the Mag 7, but we also have a way to play the Mag 7 where you can own them collectively in the what's called the concentrated Qs. We have a 2x bull product that gives you exposure to all the Mag 7, equal weight approach, 2x bull, QQQU, and a non-leverage inverse bear, QQQD. So there's a way to play it a la carte, so to speak, with the single stocks on their own, if you're bullish or bearish, but also collectively through one package, the ETF of bull or bear we have that equal weights all the Mag 7.
Okay, great, that's clear. And which types of these leverage ETFs are the most popular, and why? And why do you think that is?
Well, first, let me just take a step back. Let's look at the leverage and inverse ETF landscape. This just shows the overall leverage and inverse ETF space. There's about 100 billion in assets tied to this. There's 7 billion total in the ETF ecosystem. So this is a small portion of the total ETFs in the marketplace. What's interesting is most of the assets are tied to bull funds, and they're the highest leverage point, 3x, is where a lot of retail traders tend to gravitate, as well as the 2x, as you can see there. Our ETF lineup specifically mirrors that to a certain extent. We have right now a lineup of over 80 leverage and inverse ETFs, of which 8 roughly have $1 billion or more, and all of those products are bull products, with 3x being their leverage point, with the exception of Tesla, TSLL, which is our 2x bull. We have a broad array of leverage and inverse ETFs, bull and bear, for broad equity indices like the S&P or the Russell 2000, on the US Treasuries. Look what yesterday with the Fed, their announcement, people are playing bull and bear on the 20+ year Treasury, TMF, TMV. We also have the 7 to 10 year. And we also have a number of leverage and inverse vehicles that are tied to sectors or industries. Our most popular being our triple leverage semiconductor bull and bear pair, SOXL and SOXS. But we also have the tech sector that's been very popular, the financial sector, biotech, and of course the single stock ETFs as well. So if you want to play from a short-term trading perspective, a bull or bear scenario, we certainly have the tools for you.
Seems to cover most things, yeah. And which one of these ETFs, or which several ETFs, have seen the most inflows sort of so far this year?
Well, when we look at the top 10 inflows year to date, we have a mix of bull and bear funds that comprise of those top inflows. Some of the bull funds, for example, this year that have received the most inflows are what's called TMF, which is our triple leverage bull on the treasuries, TSLL, which is our 2x double leverage rather on Tesla, and NVIDIA as well, which we have a 2x bull, NVDU, and LabU, which is our triple leverage biotech on the bull side. Some of the bear funds that have accumulated a lot of inflows this year are on the semiconductors bear, SOXS, our bear financials, triple leverage FAZ, and also on China, as well as gold miners. So those are some of the bear funds that have received a lot of assets. So it's been a pretty mix.
Are those flows sort of significantly different from like last year? Is there that sort of a new trend as such, or?
Well, some of them are, some of them not. The triple leverage treasury has had consistent inflows for a long period of time. People have been contrarian there because the rates have mostly trended higher. Tesla, for example, and NVIDIA continue to see inflows regardless of market conditions. But the flows of our ETFs can vary greatly depending on market environment. In a lot of cases, we see contrarian trades to the direction of the market. Not always the case, but a lot of the times that's the case. Also, our funds are meant to be traded actively. And a case in point is we have a high degree of turnover on a daily basis in terms of the volume of our ETFs being traded. And that's how they should be utilized as short-term trading vehicles.
So now I understand what they are. Can you explain sort of how they work? You mentioned they seek a daily goal and there's a daily reset. Can you just explain how those work?
Sure. This next slide provides an illustration. This is a hypothetical example of a 3x bull fund. And as you mentioned, our leverage inverse ETFs reset the leverage point at the end of each trading day. And you can see in this example how the mechanism works. So let's take 100, for example, provides 300 worth of exposure. On the first day of trading, as you can see here, it's a 3x bull fund. The underlying index is up 1%. So a 3x ETF made 3% that day. So your $100 goes to $103. Now the notional exposure where we provide the leverage, that goes to $303. So when we're resetting the leverage for the next day to the farthest right, you need to have the cash of $103, which you have, which is your cash investment, have $309 worth of exposure to match that 3x return for the second day. So what you need to do in this case is that we need to add to our exposure to get to $309. So that's where the swap comes in. So that daily reset is whatever the value is on that given day, you need to have it match it 3 times. That's what the swap provides. So you see in this instance where you gain 3% on the first day as a result of the index, the underlying index being up 1%. So your 100 goes to $103. Your $300 worth of notional exposure only goes to 303. You need to make up that shortfall. As a result of that, the swap for the second day will add $6 to get to the 309 exposure. The bottom line is on a daily basis, it resets the leverage. You're always going to have 3x leverage in this case for a given single day. It should match that minus fund fees and expenses.
Okay, so if the ETFs are performing this daily reset, I guess the next question, and the slide looks like it's coming there, it's what kind of impact does that have on the longer term performance of the ETFs?
Well, these are path dependent during the time you own them. So you really got to monitor these day to day. And this is an example of positive compounding where the trend's your friend and it's stair stepping in your direction. As a result of that, you could get a return that is greater than over this time period, the index times 3 cumulative return. So that's where positive compounding comes into play. You'll notice also that if you're on the wrong side of the trade, you had a significant loss, but that compounding is a little less from a loss standpoint than maybe that cumulative 3x return that you're timesing over that period of time. The bottom line is that there's going to be compounding after a single day, and that the path of the underlying index is going to matter. And if something is trending in your direction, that leverage could work for you. The flip side is on the volatile side. If the trend is not discernible and you have a lot of volatility, both to the up and down side during the time you're trading, you could have not as good of a gain in this case as if you just took the cumulative return of the underlying index over the period times 3, or your losses could be more excessive. Just to illustrate this point further, we have bull and bear pairs of the same index that if you have very volatile or choppy markets over a period of time that you're trading it, both the bull and the bear vehicle could both be down during that type of scenario. So it's important for traders to realize to monitor day to day. Every day is different. The market conditions can change. And as a result of that, that could greatly impact your returns over a cumulative period if you hold beyond one day.
Yeah,
So on
I
this,
think that.
yeah, good. Sorry.
So timing matters significantly in these sort of ETFs about the length of time and how to trade them. That's the key point here.
Yes, definitely. The timing matters. These are timing trading vehicles. And to illustrate this with some real-time examples, this is just looking at this slide over a month period in 2003, August of 2023, how things could change intra-month even. And if you notice, this is representing the Technology Select Sector Index and our triple leverage bull and bear that's tracking that index, TECL and TECS. And you could see the first half of the month of August 2023, if you were in the bear camp, that was a good trade. However, in the second half of August, the tech sector rebounded. And if you overstayed your welcome on the bear trade, that could have hurt your returns significantly. So you could see that the timing matters and that you really need to monitor these every day, because the path of that underlying index or the trend might change. And you need to be prudent to that and really be quick to get out of these things or enter these type of trades based on the underlying index and how it's performing. And then just another example on the next slide is the junior gold miners, for example. And we have a double leverage product on the junior gold miners, bull and bear. And you can see in the month of February of this year, if you were bullish on junior gold miners, you took a significant loss. The flip side is you made a significant amount of money on the bear side. But again, if you weren't nimble, if you held during the month of March, the opposite occurred. And in fact, the junior gold mining index was up even more significantly than it was down in February. And you could see that was very favorable for the bulls, but the bears had significant losses. So again, timing matters, the path of the underlying index matters. Every day is a new day, and you have to be monitoring these on a day-to-day basis, as this illustrates.
Okay, that's great. So it's time to turn this over to all of you tuning in about the questions. There's some here on the Q&A sort of chat. So don't forget to upvote the questions that are on there you'd like to see answered. There's one here from that I'd like to sort of start with. It says, can you explain the impact of liquidity on ETFs? For example, on low liquidity ETFs, is there a high risk of slippage?
Well, when you look at it, we're designed minus fund fees and expenses to track the underlying index, whatever magnification of leverage, bull or bear. So the one thing you want to be cognizant of with any ETFs are how it trades, the bid-ask spread, how wide that spread is. And in addition to that, maybe limit orders would make sense in a lot of cases. And in addition to that, you really need to know what your risk tolerance is when you're trading these type of vehicles. But the liquidity for our vehicles is all about the underlying. A lot of our vehicles trade very actively in terms of volume and turnover day to day, and they're designed for that. But you really want to make sure that you know what the underlying index is we're giving you exposure to, and comfortable with the liquidity of that underlying index, and that we're providing that exposure on a day-to-day basis.
Yeah, that's great. Thanks. Stock splits are quite popular these days, yeah, with Nvidia up there. So when a stock splits, what happens to the 3 times sort of like ETF?
Well, just to reiterate, the Nvidia product we have, NVDU, on the 2X is a 2X bull. But regardless of that, the other thing to answer the question is a split with the common stock has no impact on Direxion's ETF. Because whether or not the Nvidia common stock trades at 1,000 or 100, it's the percentage gain or loss with the common stock in a given single day. That is what we're tracking with NVDU. So that's what you have to look at, is what Nvidia, the common stock, did in a given single day. We're not going to split our ETFs based on the common stock splitting their ETF or splitting their stock, rather. Our ETFs are independent of that. We may have reverse or forward splits. We have corporate announcements for that. But again, we're tracking the common stock day to day, the percentage gain or loss. And that's not going to be different regardless of whether or not the common stock splits.
Good. I think the next question we've asked, you've answered in the presentation already, but why don't we just sort of go over it again, because someone's asked the question about, why shouldn't you use leveraged ETFs as long-term investment vehicles? He's highlighted that a couple have had outstanding 10-year records regardless. I suppose it's just worth reiterating the dangers about those resets and the refixing.
Yeah, I mean, as we touched on, you got to rely on trends that consistently move in one direction. No pun intended there. You really need to look at these on a day-to-day basis because of the compounding impact once you own them past one day. I don't know too many markets that go straight up forever or down forever, but the fact is there's going to be volatility in those underlying indexes or single stocks. And that could mute even the returns of a 2 or 3x bull product if you're on the right side. And if you're looking at it over time, you may not get that 3x return. It might be much less than that. So is it worth taking the risk of a triple leverage or double leverage product when you're holding to get returns that are not commensurate to that 3x because of the compounding and the path of how it gets there? We don't pass merit on how long to hold these. That's up to the individual, but I could tell you the most effective way and how they're designed to be used is on a shorter term basis and to review them on a daily basis.
So as you say, given timing so important, one of the questions here being asked is, what's the best way to keep on top of these things? Do you suggest technical analysis, keeping closer to fundamentals, events? I mean, is there anything that you think sort of works best?
Well, I think it's a combination. That's a good question. Some people use very short-term technicals for their trading, but also have tight stops if they're wrong. That's one thing also that you want to be aware of. What's the maximum loss that you're willing to take? And with any of these type of leverage vehicles, you have to really have a risk tolerance and a high degree of risk when you're taking on these type of trades, even with those stops. Fundamentals, for example, like yesterday, a lot of our short-term active traders are trading based on headlines. And look at this morning with Tesla, for example, with approving or reapproving the pay package for Musk. You're seeing a reaction in Tesla's stock, and it's been bullish, at least this morning. Or trading off the Fed last night. You see what happened to interest rates and equities indirectly as a result of what the Fed's statement was in terms of forward-looking statements. So all of those combination of things we're seeing traders trade off of. Some trade a combination of technicals and fundamentals. Others trade purely on fundamentals. The one thing you have to do, though, regardless of what you're looking at to make your analysis, is you have to have a short-term view, when you're trading these type of things.
Okay, that's good. And then I suppose someone's asked here, any plans to create a leveraged ETF that tracks Bitcoin?
We're always looking for new ideas to bring to the marketplace. As of right now, we don't have plans for that. There may be some other types of strategies we bring to the marketplace, including some that might have some correlation, but not a direct exposure to Bitcoin. So stay tuned more on that. And, for anybody that wants to sign up to our Direxion alerts, for example, we'll show that in a minute in terms of the link. It's all our corporate actions, including any fund potential openings. We've launched a number of products this year. Most recently, we launched some leverage artificial intelligence basket of stocks. So if somebody wanted to take a bullish or bearish view on that, AI and big data, That was one of our most recent launches, as well as Meta to round out the Mag 7. That was our most recent launch in terms of a 2x bull on Meta and a non-leverage inverse bear as well, METU and METD.
Question here, just about tax deferred and tax free accounts. Can these be held in those type of accounts?
They should check, but it's an ETF. It is eligible, should be for certain ERISA accounts, like an RIA, for example. They should check with their trading platform and their accountant. But we're seeing a number of retail traders using inverse ETFs as a way to either hedge short term or take an outright short position, whereas they couldn't do that in some type of ERISA accounts previously. Before these inverse ETFs, you couldn't short directly. So you really should check on your retirement plan for that. But some of them should be eligible. It just depends on the structure of what it is.
Okay, good. And then are the bid-ask spreads on all the ETFs, are they set? Do they depend on sort of like the different ETF and the leverage, or does it vary according to market conditions?
Well, the bid ask on each ETF is going to be contingent on the underlying index and the leverage point to track for any given single day. And then what's called a discount or premium, that's embedded within the market price as well. So if there are more buyers than sellers or more sellers than buyers, that might be reflected in a given intraday or at the end of the day. And that's one thing that, regardless of the ETF, whether it's leverage or non-leveraged ETFs, ETFs have a market price. Most people like you and me, Russell, will trade off that secondary or market price that you're seeing on all your trading platforms. But we also publish what's called an NAV. All ETFs do. What's an NAV? It's basically the fair value of where it should be trading at. And that discount or premium is the difference between the market price of where it closed, where you could buy and sell it, versus what the fair value is. So you could, at least an investor or trader could see if I'm buying a little higher than what the fair value is, or I'm buying a little lower than what the fair value is, or selling. So that's one thing, regardless of an ETF, whether it's leverage or not, that people should be cognizant of. But we're going to track the underlying index with the magnification of the leverage point on a daily basis, minus fund fees and expenses, as well as those discounted premiums.
That's great. And just the last question, because we're beginning to kind of get out of time. If someone wants to create a trading plan, is there anywhere for education and training or some tools? Is that something that, we're going to offer at the end of the call, or is there points where which you can talk about?
Well, I don't know about specific where we have something where trading tools. What we do have are some education on the things we discussed, and that's our Direxion, Direxion.com. And then we have a separate section for leverage and inverse ETFs, videos, a university that people, at least if they're going to look at these type of products to trade, should have a full understanding of how they work before they should consider them. So that's paramount, as I mentioned at the beginning, to Direxion. First and foremost is the education for potential traders to make sure they have an understanding before they invest, or before rather they trade.
That's great. Thank you. I'm afraid that's all the time we have for today. So thanks for joining us. I hope it's been enlightening and informative for all of you. Please join us for the Modern Investor Summit on December the 3rd and 4th. It's a 2-day event packed with back-to-back sessions and workshops led by the biggest names in finance. And don't miss out on the incredible opportunity to increase your investment knowledge and network with fellow retail investors. And lastly, as you leave the event today, a pop-up survey will appear on your screen. Please take a few minutes to let us know what topics you're interested in and hearing about at future events. Thanks very much.
Thanks for having me.